So welcome to Understanding the Basics of Individual Tax Return. My name is Dhiren Khatri, and I have been in this profession of a CPA for over 10 years now. As my full-time job, I work for a company where we don't do individual taxes. We're doing corporate taxes. But as my passion and hobby, I do individual taxes for a few friends and some other people that I contacted through, my small network. So I do prepare taxes for them, and I've been doing that also for about 10 years now. My purpose for doing this was that give you guys an idea of what it takes to do your taxes. I will not be walking you through the entire tax return because I felt that maybe it's too dry and boring, and you may feel like just sleeping right here. So I kept it as theoretical as understanding possible. So these are certain topics that I'm going to cover. What are some filing statuses that people have question about? Should I be filing this or that? Dependents, if you have questions about the dependents, how do you know if I have a dependent or not? Different types of income that you would need to report on your taxes. Any adjustments that you can take, which is the important part, because income, you have to report no matter what. Adjustments are where we forget that, hey, I could take advantage of that and I could lower my taxes. Deductions, again, different types of adjustment, and deductions also include some credits that you could probably take, and how to review your work and check some common errors that could come about. A disclaimer that this presentation is for the purpose of education. It is not meant as a tax advice. So if you have a tax professional that you go to, you should consult your specific tax question with them. If you have any questions that I can answer, I'll definitely try and answer, but you shouldn't take that as my professional advice to you as a tax professional. Okay. Before going into that, a little philosophy in how this tax works. And if I don't understand it, I sometimes just feel like it's just a routine that I have to do. So before, I always used to think, I have to fill out a tax return, I have to fill out a tax return. And we go through this ordeal of, the government, Uncle Sam's gonna come after me if I don't fill out my taxes. What is the tax return for? If you have earned income and you have paid taxes, there's very well likelihood that you may have overpaid in taxes. And this is an opportunity for you to get that tax back. So if you feel that you have overpaid on taxes, you should fill it out and check it out that are you due a refund from the IRS? And what the IRS is doing is it's checking the amount of income that you earned throughout the year, and it accounts for certain life changes that you may have had. And these are all the deductions, the adjustments that we're going to talk about, which the IRS may not know, which you may not have even told your employer at the time when you started your job. And these adjustments, they get accounted on this tax return, and through which you can get a refund back, or you lower your tax liability. So our goal is to figure out a way to get lower tax liability, which means more money in your pocket at the end of the day. All right, so keeping that in mind, we go forward with our presentation. All right, some common filing statuses that you will see. If you have the form, you will see them on there. But these are the 5 common statuses that are there. single. If IRS considers you're a single, if you're not legally married, and legal marriage means that a state has recognized your marriage, then you're married. So at the end of the year, if you were not married, then you are considered single for the entire year. If, say, you were married and your divorce was finalized by the last day of the year, you are considered single for the entire year. So there are some nuances, some exceptions you will see to many of these rules that we will talk about. But single basically means is that you're not legally tied to anybody for the year. So you would use that as your status for preparing your taxes. And there are implications of these filing statuses, and we'll talk about that as we go along. The next one is married filing jointly. It's very simple that if you're married, legally married, then that's what you want to choose. There are advantages to choosing married filing joint, and we'll talk about those advantages as well. But as married filing joint, say your spouse passes away in the year, then you are still considered married filing joint for that entire year. I know it's a sad thing, but on the tax purposes, the IRS allows you, or it considers you married for that entire year. The next status is married filing separate. Many times I get these married couple asking me, although we're married, can we file separately? My advice to them always is you shouldn't, because you're getting some benefits, some advantages, and we'll talk about that, of married filing separate, which you don't get, of married filing joint, which you don't get of married filing separate. But there are times when people do choose, either they are separated from their spouse, and therefore they do not want to file jointly, or they choose to file separately, whichever it is. But you do have an option to file separately. And we'll talk about the implication as well of that. And then there's another status called head of the household and qualifying surviving spouse. And again, I have slides that talk in detail about each. So going to the next, when to file married filing jointly versus married filing separately. So you want to use married filing joint because it lowers your tax bracket. As a joint couple, the IRS allows you a higher allowance of income to have. Whereas if you were separate, your tax bracket would be higher. Now, how that works is everybody, I feel or hope, understands that in the United States, it's progressive tax, which basically means that you don't pay one set percentage on your income. It's a bracket. So at the first level, say your income is from 0 to 11,000, and I believe that's the number of bracket. I don't have the full bracket on my up my head, but you can get that on the tax forms and the instructions. They have the brackets laid out. But what happens is the first $11,000, you will be taxed at 10%. Then they check from 11 to 44,000, and it will be taxed at a higher tax percentage. Then they go from 45 to, I'm just estimating right now, maybe 85 or 100,000. Again, it jumps to the next tax bracket. So that first 11,000 will be taxed at 10%, then the next will be taxed at 12%, then the next will be taxed at whatever that rate is. And this is what is called as progressive tax. So it's not that if you earned $100,000 in taxable income that you will be taxed one tax percentage. It'll be different at a different level. So therefore, if you use married filing joint, you get a favorable tax bracket because there's a different bracketing for married couple against separately. Another is, if you file married filing joint, then you get benefits of some of these credits, such as earned income tax credit, child and dependent care credit, education credit. These are not available if you were to file using married filing separately. So therefore, you could lose out on these benefits. But when does it make sense to file separately? If you want to separate your tax liabilities. Because when you file jointly, you are jointly responsible for all the income. So you're combining your and your spouse's income on your tax return. And say you don't want to be liable for your spouse's taxes, and then you separate it out. An example I give is, if your spouse is overseas getting income, which is called as foreign earned income, then it's beneficial to file separately because you don't have to pay tax on that income earned out of the United States. And there's a different form that your spouse would have to fill out. So in such instances, it makes sense. And the other thing is, one spouse has large itemized deduction, and that is subject to AGI limit. What that means is, when you are filing jointly, you get to itemize. I'm sure everybody has heard of this word, itemize. Standard deduction versus itemized deduction. So in itemized deduction, what happens is, there are certain things that get capped because of your adjusted gross income. What is adjusted gross income? Is after figuring out all your income and your adjustments, the income that comes about that is subject to tax, that is what is called as adjusted gross income. IRS uses this number and it caps some of your deductions. But when you're married filing joint, this cap is higher because your income is higher. And if you were to file separately, you can find that you will be able to take the itemization because you are at a lower AGI level. One example I could give is, you own a house, and if you own a house, you can get a deduction such as an interest on your house, the mortgage interest that you pay, real estate taxes that you pay. Now, if you were to do a married filing joint, then your AGI is going to limit you in taking the itemization. But if you were to do it separately, obviously the other spouse is going to suffer, but you may come out better. That is the situation with these married filing separate filings, that you can itemize and you can get a better refund. So that's how many times people have done it. I hope this is good. You're okay with this much? All right, we'll go forward, and then if time permits, then we'll do questions. Okay, head of the household. These are certain things that many people don't realize, and you can take advantage of this. So what is a head of a household? And these are certain requirements that the IRS states that should be met. And if you meet these, you can qualify as head of the household. You are unmarried or considered unmarried. So we already talked about the statuses. Unmarried means you're single. You could be married, but you're considered unmarried if the spouse was not a member of the household for the last 6 months of the year. So if you weren't living with your spouse for last 6 months of the year, you could be considered unmarried. And you're not a surviving spouse on the last day of the tax year. So, right, so when you're unmarried and you're not living with your spouse, and the household is the principal place for your child, meaning your child was living there, and you have the eligibility to claim your child. Whether you claim your child or not, that's not the concern what the IRS has, but that is a place of abode for your child. So that's one requirement. The second is you maintain a household by paying more than half of the cost of keeping up the home. So you're putting up more than half of cost for maintaining that home, and a qualifying individual has lived with the taxpayer in the home for more than 1/2 of the year. So it could be your child, or it could be your other relative. And we'll talk about the qualifying individual requirements.
So I have a question.
Yes.
So if I am unmarried and living alone and my kids are grown up, nobody's dependent on me, right? I can still claim head of the house?
No. So you require this qualifying individual. So it could be that you have a sibling that lives with you, and you could still use that as a head of the household status. So you have to be head of the household. That's how you have to think about it. You can't be single.
Also head of the house, but it doesn't count in that.
Correct, yes. In the eyes of the IRS, it wouldn't count. So the question was that if I'm simply living alone and I have nobody who is dependent on me, can I still take head of the household? No, that doesn't work. Yes.
You're single and
Just to say, I'm going to have this because you're calling.
hi. My question was, if you're single and you're caring for your parents, would that count?
Yes. If you're caring for, so there's that rule here that unless the person is the taxpayer's dependent parent. So if you have a dependent parent and you have all the other stuff being met, you can claim yourself as head of the household. Basically what that does is it bumps your deductions. The standard deductions increases if you have head of the household or qualifying survivor spouse or married filing joint. These are the higher deduction statuses. Okay, this helps? I hope it helps. So you want to think about it that you are actually a head of the household. That's why you're claiming this as a general rule. But these are certain specific things, and obviously there will be some exceptions, so you have to consider those. Each situation is very unique. Okay. Qualifying surviving spouse. So if you remember, I had mentioned that if a spouse passes away, the year they pass away, you still qualify as a married filing joint. So you don't want to use qualifying surviving spouse. But the following year, you can use this as a status, and it gives you a higher deduction. So what this is saying is you have been entitled to file as a joint return. Whether you filed it that year or not is a different question. They're not concerned by that. But the IRS is saying that you were entitled to file as a joint return in the year that your spouse passed away. And you did not remarry during that year. If you married again, then you would use the married filing joint status. But if you did not remarry, then you have for next 2 years to use this as your status, qualifying surviving spouse. and you maintain a household for the entire tax year that is a principal place of abode of a child, adopted child, or stepchild whom the taxpayer is entitled to claim as a dependent. It says that you're maintaining a household. It doesn't say that you have a child living with you. So if you're maintaining a household where the child, say the child is off to college, you would still be considered. Say your child lives with you, but you don't have to claim them as a dependent. Then also you could still use that as a qualifying surviving spouse. You're entitled to claim that as a dependent, but you're not wanting to claim them, or you don't have to claim them. So you can still use this status.
Wait, and
Yes,
this goes on for 2 years after the death of the spouse?
yes. Oh, the question was, this goes for 2 years after the death of the spouse. Yes. So the year that the spouse passes away, you're still considered married filing joint. And the 2 years after, so for next 2 years, you can use qualifying surviving spouse.
And that gives you a higher deduction?
It gives you a higher deduction, and I have a bracket where you will see the deductions for 2024 that the IRS is giving. Okay, any questions on the filing statuses?
What constitutes a child?
What constitutes a child? I do have a slide on that as what is considered a child, or who is considered a child. So we'll talk about that. Okay, certain time a question comes, should I file my return or not? These are some thresholds that tell you if you should or should not. If you are single and under 65 and your income is $14,600 and above, then you should file the tax return. If it's below that, then you don't have to. But even then, I would suggest you should, because you don't know whether you will be receiving a refund or not. So you should fill it out. If you're getting a refund, you should file it, get the money back from the IRS. If you have Social Security income, and that's the only income that you have, you don't have to file the tax return. It doesn't matter what status you are in. Yes. If that's the only source of income that you have, then that is considered non-taxable. When you have your Social Security income, and then also on top of that you have income from wages and things, then there are some complications that come about, and some of your Social Security income also will be taxable, and therefore you would need to file. But
Like a dollar in interest income, somebody would have to file?
no, so that's what I'm saying, is if you have just dollar in interest income,
On top of Social Security?
oh, no, you don't have to.
Oh, okay.
Yes. If you're having, again, above that 14,600 status, or if you're married filing jointly and 29,200 in interest income or more, you should file it.
A very quick request, if you have a question, just raise your hand up. I'm just going to bring this over to you. This is the only way you will catch it for the recording.
Yes.
So to clarify, say you're getting $35,000 in Social Security, and that's it. You don't have to file.
You want to repeat the question in the microphone so that way we get it for recording?
Your Social Security income is, say, $35,000 a year, and you have no other income. You do not have to file?
That is correct. You do not have to file. Social Security income is not considered taxable income, if that is the only source of income that you have.
They tax it anyway. We got all that other stuff.
Well, they will tax it because when they, so that's another thing. So say you are receiving Social Security income, and on your form that you get, that SSA form, you see a tax being taken away, If you've chosen to pay tax, then you should file to get the tax back, because Social Security income is non-taxable. Yes, so if you have your taxes taken away, file it and get the tax back. Okay, let's move next.
I have a question.
Yes.
So besides social security income, say you have income coming in from some investment, dividends, CDs or treasuries or bonds or any of that does not.
Right, so that's what the question was, is on top of the Social Security income, you have all these interest income, or what we call as passive income. That's the threshold we're talking about. So use this as a threshold to figure that out. Okay. Additional notes on your filing threshold said, gross income includes all income, right? That's how the IRS says. Any income from whatever source, as long as it's not exempt from taxes. And you don't include your Social Security income, as we talked about it. And then the threshold could differ if these complications come, where you have something called alternative minimum tax. We're not going to go into it. It's a very complex topic. It's beyond the scope of our basic understanding. And if you receive advanced premium tax credits, meaning if you have gone through Marketplace to get insurance and you're getting tax credits on your insurance premium. So that will change the threshold. Okay, who qualifies as a dependent? I think someone had a question. Who is considered as a child? So here are certain criteria that the IRS gives, and these are what you use to claim a dependent. So you'll see a section where you have to list out your dependents. So if you have a qualifying child, a child is considered by relationship either a son, a daughter, a foster child, a sibling, and there are some other restrictions as well. But that's the relationship. And the other is they're under 19 of age. And if they are a full-time student, then under 24 of age. Residency, they have lived with you more than half the year. If a child is away for college, they have lived with you for the entire year. So these are four things that have to meet, and the support test, that you provide more than half their support, then they are considered your qualifying child. A qualifying relative is, yes,
Sorry.
yes.
If I have a child out of United States, it's considered a qualifying child?
Does that child have a valid Social Security or a ITIN number?
Yes.
Okay, so if they have a Social Security number, are they just living abroad as a, have they gone for like a vacation, or are they living there by choice or something?
Well, because my son is considering going to, for example, Spain to study college or university there. So after that, can I select him as a qualifying child?
Absolutely. So if your child is going abroad for studies, but he has a valid Social Security number and everything, and you meet those requirements, yes, he's a qualifying child. Somebody just recently asked me a question that I have a child who is out of United States, but they do not have a Social Security number, then you can't. You would have to apply for their ITIN number to get a tax ID number, and then you have to show that they are being supported by your income, which is very hard to do. So therefore, if in that situation that you said, yes, I would say they are a qualifying child, and you can claim them as a dependent. If a qualifying relative, so who is a relative is any relationship other than the qualifying child. So it's a very broad spectrum. And just to name few, it could mean your siblings, it could mean your half-brothers, children, or a stepchild, or your parents, or your in-laws. There's a big list of who is considered by relationship a qualifying relative. So therefore, you can check the instructions to see if any of your relative can qualify. So there's a relationship test that has to be met. Income test. They are earning income less than $5,050. That is a qualifying relative. So if their income has gone above $5,050, then they would not be your dependent.
That's excluding Social Security.
That is excluding Social Security. That is correct. And support test, you provide more than half their financial support. And residency test, they must live with you all year as a member of your household. So they must be with you. I mean, if they have gone for a vacation, that's considered they're living with you. Yes.
If your child is also earning and under the age of 19, are they considered a dependent?
If your child is under 19, they're still your dependent. Yes. As long as you are supporting them with their financial support. So you should be paying half of their support.
What if you are supporting a sibling who is in school, like grad school,
If you're
not living with you?
if you're supporting a sibling and they're in grad school, are they getting like some kind of stipend or something? They're not earning any income, right? And you said they're in grad school. So they're probably not living with you. But is their address your address? Like, are they dependent on you?
They are.
Okay, so if they're dependent, you can claim them as your qualifying relative.
But under 24.
Well, it's a qualifying relative. So she's talking about a sibling.
Oh, I thought you said child.
Yes. Yes.
Okay, what if you have,
Just a
say,
moment.
a full-time student?
Just a moment.
Okay, what if you have a full-time student who's, say, 29?
Okay.
Would that be considered a qualifying relative if you support them?
Yes. So do they have an income?
Scholarships.
Okay.
And also financial support. Does that include tuition or just living expenses?
Living, tuition, everything. Whatever it takes to support them, whatever financial resources they need for that entire year.
But the scholarships are paid for the tuition.
Okay, so that's fine, but.
So fine, you could still
Yes.
qualify if you're supporting their
If their livelihood is supported by you, then you can claim them as your qualifying. You said your child?
well, my sister's child,
Oh, your sister. Oh, okay.
but I'm asking for her.
Oh, okay, okay. So if they're not earning anything and it's just the scholarship that they're getting,
Yes, yes.
yes, you can definitely claim them as a qualifying child. Yes.
Open relative, right? Over 24.
Well, she's talking about for her sister.
Even-
For sister can, she can't.
But her still over 24 though.
But he lives full-time in the house.
Right. So
They're not supporting themselves.
right, they're not supported by themselves. So the parent is supporting. So another thing is that
But they have to be under 24. She said they're 29.
Correct, yes.
Qualifying relative.
Right.
Right, they would be a qualifying relative. Yes. Yes.
For example, if my son is working a part-time position, so he's still my qualifying child?
He's working part-time?
It's not, but it's a case. For example, if he will be a part-time worker, so still he is my qualifying child?
And how old is he?
19.
Okay. If he's 19, he's going to be working. Is the money that he earns, does it support himself? Or you're supporting him? And does he live with you?
He lives with me.
So if he lives with you and the money that he's earning is just, say, for his leisure or for his, cell phone bills and things like that, and the rest you're supporting his livelihood, then yes, yes.
There's no limit on the income that the young man can make.
Well, there is. Right, there is. There's a limit, but the limit is determined based on the support. Like if they're earning $40,000 a year and you're saying that they're supported by you, then you must show that they really have like $100,000 of expenses in a year that you are paying $60,000 of their expenses, right? Which is very hard to do.
I wanted to come back to the question from before. Like if you're supporting a sibling who's in grad school, but they're out of state, so they're still, like you're supporting them financially, with tuition, all that, but they're not living with you. Would they still count as qualifying relative?
If they're out of state,
I mean, like their permanent address would be your address, but they're just there for school.
correct. So you can qualify them as a relative, yes. Yeah. Okay. So, I'm sure many were not here when I was making this disclaimer. This is for educational purposes only. So don't hang your head on me and say that, well, Darren told you, so that's why you're going by it. You should
telling us.
you should refer to your tax professional. If you hire me as a tax professional, I'll give you personal advice at the time. So these are just hypothetical situations that we're coming up with, right? All right, so each dependent must have a social security number or an ITIN, which is tax identification number, or individual tax identification number. Okay. Impact of dependent on your return. These are certain things that you should consider. You may qualify for a child tax credit. If your income is low, then you can benefit from earned income tax credit, and you can get some dependent care credit. Your filing status, as we talked about it, could go to head of household and your higher standard deduction. And you can also get some credits, which we have talked about. Okay. All right, some sources of income. So now we come to what are different types of income that you normally will see, but there are multiple sources of income. The way the IRS defines is income from all sources is considered as gross income, meaning if you walk down the street, you picked up a $10 bill, that is income taxable. Would people report it? That's a different thing. But it's considered a taxable income by the IRS, and you should report it. Okay, how many people see it is wages, salaries, tips, so you get income through your employer. Interest and dividends, some passive form of income. You have a business and you get a self-employment income. capital gains. When you have some investments, you sell them and you get capital gains. Retirement, so you have a 401k, IRA, and you get a distribution. That's another source of income. Unemployment income, as we were talking about, Social Security, and gambling. So that's another way you're getting income. These are all reported on your tax return. Certain forms you will see where you can report this, or certain forms you will see they are reported on is this Form W-2. Many times people I've seen is when they fill out with their employer what is called as W-9. Your employer tells you that what are certain deductions you want to take from your taxes. That's the form you would fill out when you actually start your job. And many times people are very honest about their livelihood situation. So what happens is you say, I have 3 children that are dependent on me, and et cetera, et cetera. And because of that, the employer will cut less tax from your paycheck. And after considering all the situation, you'll find at the end of the year that not enough tax was cut from your paycheck, and you have to owe taxes. So if such situations are coming up, you should go back to your employer, let them know that, hey, I'm getting my taxes, not enough taxes being cut from my paycheck. I would like to have that tax being cut. So that will correct the situation. You have to see it from different ways. One is, would you rather hold on to the tax and pay Uncle Sam after the year goes by? Or would you rather have the Uncle Sam hold on to your money and you get it back from them after? You decide how that has to go by. In the first case, where you hold on, the consequences is you have to pay some penalty and interest on not paying enough tax. And the other is you give them the money, but you don't get enough interest from them. They're not going to give you interest when they give you a refund, right? So there are some plus and minuses in paying these taxes. Okay. Yes.
So what about estimated taxes?
Yes, I will come to that part towards the later part of the presentation. Form 199 or 1099 NEC. This you will probably get if you're working as an independent contractor, or say you have like a part-time gig with Grubhub or Uber or Uber Eats, et cetera, et cetera. When you do such things, then you get what is called as 1099 NEC. According to the IRS, they can be considered as business income or non-business income. Most of the time, IRS will say that is a business income, because if it's a normal course of trade or business, that's how they see it, is what you were doing a normal thing? So if you're doing Uber Eats or Grubhub or whatever extra delivery thing that you do, are you doing it on a consistent basis? And if you are, you're considered as an independent contractor or a part-time employee, and that would be considered as a business income. The negative side of having a business income is you have to pay tax on that, which is called a self-employment tax. So that's additional tax that you would have to pay. If it's a non-business income, you don't have to. It's added to your total income, and then whatever tax comes about is what you have to pay. What is a non-business activity? It's a one-time thing that you did. So say, for instance, that if I were to do this presentation as a as a paid presentation, then the money that I get from Schaumburg Library, I would have to report it as a non-business income. But if I were to do this, say Schaumburg Library, I go to Palatine Library, I go to Hoffman Estates Library, I go to Arlington Heights Library, I do this as my routine, then it becomes my business income. Yes.
So if I have a W-2 from my main employer, but then I'm also an independent contractor for another company, can I file them like on the same forms?
Yes.
Oh, okay.
Yes, absolutely. Correct. You just have a different line, so you will see on the tax forms that you have, there's a line for business income or something that goes along the line. So you will see a separate category where you'll report this income. It's a hobby income. Now, another thing is, when you claim it as a business income, you can take certain deductions. When you claim it as a non-business income, you can take some deductions, some expenses. So if I were to take an income, I'm not getting paid, just to let you know. But if I were getting paid, the drive that I did to come here, I can claim that as a deduction. But if it were a hobby income, I can't take that. All I have to do is just report my income. So there are some plus and minuses to having an income like this. Okay? You will get a form which is called 1099 INT for any of your interests. You will get something called 1099 DIV, which is dividend income. And you will get something called 1099G for any of your state refunds. Hardly now that you see these come, but they do come from the state government. And always match your reported income with the form to avoid any IRS mismatches. Okay. Schedule D. This is the form that is used to report your capital gain income and capital gain losses. So if in 2021, I believe, many people got involved in stock market. As the market was going up, everybody was putting their money away. And when I was seeing it, I was like, everybody seems to be investing in stock market. And the year after, everybody was having a loss. So you see the benefits. Say you are investing in a stock market or any of the markets, say mutual fund or any ETFs or any of that. When you sell shorter than 1 year, it is considered as short-term income or a loss. If it's a loss, no problem. If it's an income, then the income is taxed at your tax bracket. So whatever your tax bracket falls into, you will pay income at that level. If you held the investment for more than a year, then you get a preferential treatment, and that gets taxed at a different bracket level. So a certain amount gets taxed at 0 rate, meaning you don't have to pay any tax on that. If it goes beyond that, then you pay 15%. If it goes beyond that, then you pay 20%. So, and the 20% is the max. So the maximum you'll pay is 20%. So if you are considering investing, you should consider investment that are long-term, where you don't have to pay higher taxes. Otherwise, you would pay taxes at your normal tax rate. And the form that is used is called Form 8949, and it details out your transactions.
Is this for non-retirement?
So very good question. If you have money invested in some IRA accounts or things like that, you're seeing these fluctuations in market, the income that you get, the capital gains and losses, are not taxable. So the retirement income is not taxable. These are all non-retirement related income and expense or investments. And you get taxed on your retirement income when you take a distribution. So when you take the money out of your IRA account or whatever 401k account, you will pay tax at that time. Unless you had one of those called Roth IRA account. I'm not sure if you're aware of that. But when you have Roth IRA, then you don't have to pay tax on it because it was you already paid the tax when you put the money in. So you will not have to pay any tax that time. If you have net losses, net capital losses, then you can take about 3,000 of that against your ordinary income. So that is one favorable thing that you will find. So I tell one of my client, he likes to gamble. I said, if you really want to gamble, why don't you put your money in stock market instead of gambling? You're throwing the money, and the losses, the thing is on the gambling income, or the gambling losses can only offset gambling income. If you only had a loss, that money is not going to offset any of your other income. Whereas here, say you lost the money in your investment, you could still take 3,000, and the remaining that you couldn't take, you can carry it over to next year, and you can take it next year. So the IRS incentivizes on doing things that are beneficial for the economy. Yes.
You mentioned that if you take money out of your IRA, it's taxed right away. So then you don't have to put it down on your income tax, right?
Right, so it depends on what time you take it out as well. If you have reached the retirement age and then you take it out, you could be able to take that, you could be able to get that tax back. But if you took it out before retirement age, then you will have to pay that tax, and you will have to report it on the tax return as well, with the other stuff.
Okay, so again, does that go on your income tax that you fill out?
Yes.
Okay.
Yes. It will, the form that you get from your bank that gave you that 1099, it will have the amount of tax that they took out. And then you can just fill out the tax return to see if any of that tax will be coming back to you as a refund or not. Okay. All right, business income. So this also is a very big topic in itself, but if you are to have a business income, where would you go about in reporting it, and what are certain things you can consider in lowering your business income? So you would report this on Schedule C, and this would be subject to your self-employment tax, as we were talking about. What are certain things that you can take advantage of? So say you're doing a work from home kind of gig, or it's your business where you're working from home, then you can take office expenses, you could take utilities, you could take home insurance, you could take cell phone bills, or you can take whatever telephone bills you have. You can take your equipment, your supplies as a deductions. You can take your vehicle, if you're using your vehicle for a business, and you can take a deduction for that vehicle. Now, if you remember, I was talking about those 1099 NEC, that can be considered as a business, and if it is, then you definitely want to take advantage of that vehicle's usage, your gas, your repairs, and things of that nature, depreciation of your car, depreciation of your building, any travel, any meals. So you want to talk to your tax advisor. What additional expenses can I show to lower my income? Additional expenses that are legal, right? Not to scam the IRS. Then you will be in trouble.
Isn't that dependent on the size of your home that you use for business?
Absolutely. Yes, whatever square footage that you're using your home for, or if you're using the whole home, because that's how your business is. So it will have to depend on the nature of your business in order to determine these deductions. Okay, tax exempt and other income. So there are some tax exempt interest income that you get. So you can see if you want to invest in certain things where you don't have to pay taxes on. Social Securities are not taxable, and then foreign earned income. So if you earned income from sources outside of the United States, you don't have to pay taxes here. You may have to pay taxes in that country. There are certain, I had a client who was working overseas as a translator, and he was getting income, but he was contracted by the United States government. So he didn't have to pay any tax on his income, because that's the deal that he made. But the other requirement is that he has to live 340 days out of the United States. So you could only get 20 days as your vacation time when you're back here. The rest of the time you're to be away. Yes?
For the foreign earned income, say you have some property in another country and you get rent, that rental income is excluded?
This is a different type of, yes, so the question is, if you have a property in a different country and you are getting a rent from that property, is that part of this? So how it says is foreign earned income. The rent would be considered as unearned. It's a passive source of income. So it's not your trade of business where you're earning that. It's a rental income. You have nothing to do with it. It's just you gave the building to somebody to live in, and you're just collecting rent on it. So IRS considered that as a foreign unearned income. Obviously, if you're earning an income like that, you would be paying taxes in the different country. You can take an advantage of what is called as foreign tax credit. So if you pay taxes in the other country, you get a credit from the IRS here.
So you're not paying taxes in both places?
Correct. That is correct. Yes. Yes.
So for the Social Security, what is the threshold?
What is the threshold for? What do you mean?
It says maybe taxable if combined income exceeds.
Yes. So if you have income from your W-2s and things, and also on top of that you have a Social Security income, it starts. I want to say, I don't have the number. It has to be a calculation has to be done to tell you what is that ratio. But I want to say somewhere around 45% of your Social Security could get tax if you have other source of income other than Social Security income. So if you have a W-2 and you have a Social Security income, your 45% of your Social Security could get taxed.
Isn't it 85?
It very well could be. It also could be, because it all depends on how much earned income you're getting.
Okay.
So, and that's a good thing is that you asked, is I have another client who has like 80,000 or so of their earned income. They're a joint married couple, but they're also getting Social Security income. And 100% of their Social Security is taxed because they are at a very high threshold. So that ratio has to be figured out by sitting with your tax professional, or you yourself going through a tax software and putting in some numbers to figure out what is, at what ratio your income would have to be in order for your Social Security to be non-taxable. Yes.
Okay, but that's
money that comes in on a W-2 form, right, which is earned income. So if you had like CDs and stuff like that where income is coming in, that's not considered, that wouldn't come in on a W-2.
That is correct. So if you have CDs and things, as I was saying, that if that income is higher than the threshold, then you probably won't be taxable. Remember the thresholds we were talking about earlier? And for whatever tax status you have, based on that, you will have to determine if it's higher than that or not.
So those would be called
Yes. So we can go right here. So this was the threshold. So say your earned income, are you married filing joint?
Pardon me?
Are you married filing joint?
No, I'm single.
Okay. So then your threshold, and you're saying, are you 65 or older? Or?
I'm 65.
Okay, so then 16,550. So is your income from CDs and all these other interests is coming out to be higher than that? There's more likely possibility that some of your Social Security also will be taxed.
I have a question.
Yes.
Taking Social Security later versus earlier, would that matter?
There is a benefit of delaying your Social Security, but it's an opportunity lost also. The thing is that the more you delay, your Social Security benefits keep going up. But the years that you were eligible to take, you're going to miss out on it. And you could have used that money for your, your life needs, whatever it could be. Or you could have invested in it, and you could have had that money grow. But it's an opportunity lost versus, income earned down the road.
Depends on how long you're going to live. I think
And that's also exactly.
the breakout is about 14 years.
Right. And that's the thing, is how you have planned your life will determine when you want to take your Social Security benefits. Okay. All right, some adjustments that you can consider. So there's something called as educator expenses. If you're a teacher, if you're an educator, then you can get some expenses that you paid, maybe your supplies that you are using as part of your education. You can take advantage of that. This is only for those who are educators. Student loan interest deduction. If you have a child who finished a college and now they are paying interest on their student loan, you can take advantage of the student loan interest deduction. Health savings account contribution. So if you have an HSA account with your health insurance. So HSA is basically when you sign up for insurance and you're in a high deductible insurance. So with that, they give you this health savings contribution account. And when you're putting the money in, the benefit is that that money that you put into your HSA account is non-taxable. So you don't have to pay tax on it. And when you contribute to it, you get a deductions also. So there's two benefits to doing it this way. But this is considered somebody who is very healthy. You don't want to risk your life by going to a higher deductible, because if you have health conditions and things like that, and you're in a high deductible, you could be paying more in your insurance cost. So this is somebody who has a fairly good health, and they could avoid paying a lot of premium. That's when they go to these kind of options. Contributions to your traditional IRA account. This is another sweet little thing that the IRS gives you, is if you are putting money into traditional IRA account, that money is not taxable. And you say you paid, say by the end of your tax return, you figure out that you are going to owe IRS some money, but you have not put money into your traditional IRA account. You have till April 15 to put certain amount of money, and that would take away from your total income, that AGI number we were talking about. It will subtract out from your AGI whatever amount you contribute to your traditional IRA account, and you could take an advantage by getting a higher refund.
Even if you maxed out on your 401k?
If you maxed out on 401k, then you can't. Yes, the 401k, traditional IRA, they're part of the same thing. So if you already have a 401k with your employer, then this already gets calculated. This is something that those who did not take an advantage of it, and they're finding themselves at the end of the year having to owe to the IRS, then they can take advantage of this traditional IRA. Yes, question?
But those contributions have to be earned income. It can't, like, somebody, uncle gives you $8,000 as a gift, you can't put that into the traditional IRA.
That is correct. It has to be earned income. Yes. The question was, the contribution has to be earned income. That is correct. It has to be an earned income. Yes.
When can you contribute to Roth IRA versus traditional?
When can you contribute to the Roth IRA versus a traditional IRA? That decision you can make the time you contribute. It doesn't have to be any later time down the road. The decision that you're considering between Roth versus a traditional IRA is when you pull the money out at the time of retirement, do you want it to be taxed or not taxed? The traditional IRA, when you take the money out, you will be taxed. Roth IRA, when you take it out, you will not be taxed. The disadvantage of that is when you are telling the IRS to tax, you could be at a higher tax bracket and you have told the IRS to take the money out right away. And when you retire, you could be at a lower rate, and now when you take it out, you don't get the advantage of it. Whereas with the traditional IRA, you could be at the lower tax bracket, and now you're taking the advantage of the lower tax bracket. So it's something that you would have to decide based on how you are, you're seeing your life to be, and when you're thinking you want to take the money out of your retirement account. Yes.
You want to pay the tax on it upfront rather than
Exactly. Right, that's the difference, right.
you pay the tax right then when you want to roll.
Correct, yes, yes. Okay, yes.
You are able to participate in your employer's 401k and also contribute in the same year to a Roth IRA or a traditional IRA. I think there is like a limit, 7,000 or something.
Yes, there's a limit.
Able to do both.
If you have maxed out with 401k,
If you not,
yes, if you have not maxed out, yes, definitely, correct. So you can do 401k and traditional IRA as long as you have not maxed out. If you max out with one, then you won't have a benefit of this. So you, again, want to check how much did you put into your 401k with your employer, and then do you see if traditional IRA works for you?
but you can also contribute to a Roth IRA.
Yes, well,
Max
so,
out your 401k.
correct.
Also do your Roth IRA.
You can definitely contribute, but with Roth IRA, you will not see the benefit on your taxes. With traditional IRA, you will, because you already paid the tax, so the IRS says is you don't get deductions. Okay. And self-employment health insurance. So if you have a self-employment and you're getting an insurance of your own, then you can take an advantage of health insurance costs. Okay, these are the standard deductions. Yes?
I got a question regarding adjustments. Do union dues qualify as adjustments?
Sorry?
Do union dues fall under the adjustment category?
Union dues, they might. I have not come across a situation like that. They might, so you may have to check. Yes. Filing status and the standard deductions that are available this year. So if you're single or married filing separate, $14,600, and if you're married filing joint or qualifying surviving spouse, $29,200, and then the head of the household, $21,900. So you could see how the standard deductions are higher for the last three categories. And obviously, if you're 65 or older and are blind, then you have additional deductions that the IRS allows. Okay. Favorite topic for many people, that can I itemize? I want to have higher deduction than the normal standard deductions that we talked about. You certainly can. These are very rare occurrences, but if you plan it out properly, you can take advantage of itemized deduction. One negative side of this itemized deduction is, if the year you itemize, the following year, say you itemized and you received a refund from the state, next year, that refund that you received from the state is taxable. Normally, state refund is not taxable, but if you itemize, then that state refund gets taxed. Small amount, but you should note that. Okay, so what are certain things to consider when you're itemizing? Medical and dental expenses. So if you're paying insurance premium for your health, dental, vision, all of that premium can go towards your calculation for your medical and dental expenses. So you want to look at Schedule A if you have a Schedule A, and you will see it on there. So all of that, then some expenses that you can consider, which are normal expenses for your medical bills, prescription drugs that you pay for. So those are all qualified medical and dental expenses. What are some expenses that you cannot include? Cost of diet food. Life insurance. If you're paying for life insurance premium, that is not considered as a medical or dental expenses. Nursing care for a healthy baby, that is not considered an expense for medical purposes. Funeral, burial, or any cremation is not considered a deduction on itemized deductions. And what that happens is, when you come up to a number of all your premium, all your medical expenses, and combined, you take a look at your adjusted gross income and you multiply your adjusted gross income by 7.5%. If your expenses are higher than 7.5%, that higher amount gets qualified as a deduction. So then you separate that part out. So that's one chunk of your expense that is above 7.5% that will be qualified as an itemized deduction. Then you go down to the next section, which is taxes. So any state or local income tax that you paid, this is very automatic. On your W-2s, you will have a state tax that you paid that comes here as your calculation. Say you don't want to consider your state and income tax, and you want to consider all your sales tax that you paid. That means you have to have a good tracking system of all the sales receipts that you have, and you calculate all your sales tax that you paid for the year, and say it comes out to be more than the state income tax that you paid, you can use that. It's either or. Then your real estate taxes. So if you own a property and you pay real estate taxes, then you can take that also as a consideration for your itemized deduction. Your personal property tax. So if you are paying tax on your car that you newly purchased, you can take that. Any car registration fees, that also can qualify as a tax. And If you combine all of that and it comes out to be over 10,000, then you can only take 10,000. If it's less than 10,000, whatever that lower number is what you add. So you're now going to take whatever was above the 7.5% of AGI plus the taxes you paid. Then the mortgage interest. So say you have a mortgage on your house, then the mortgage interest that you paid your bank, that amount you add as a calculation. Then any charitable contribution. Charitable contribution could be of the nature of cash or any other items. Whatever that amount is, you report that. Many times people ask me, do I need to have a receipt? My answer is, if you want it legal, you should have a receipt. If IRS comes and audits, they're not going to say, well, it's a $10 thing, I will let you go. If they come and find it, they'll say, we'll take away that deductions. So if you can back it up with a receipt, it's a solid proof for yourself. If you can't, you can take a risk and you can take that chance and see if the IRS is okay with it. So cash or any other item. Another thing to consider is, say for some reason you couldn't take all your charitable contribution, you can carry it over for next 5 years. So say for some year you came into inheritance, but you didn't want it, you contributed it as a charity, but you couldn't take all of it that 1 year, you can split it over next 5 years. Any casualty and theft losses, and after all of these, you add them up. If by adding it up, you are above your standard deduction, then you want to use your itemized deduction. If you're below, then you are good with standard deduction. So that's why I said is you plan it out, and if all things fall together, then you may take advantage of the standard deduction. Oh, sorry, itemized deduction. Okay. Okay, generally choose the method that yields the higher or larger deduction. Oh, sorry. And most taxpayers benefit from standard deduction unless they have these situations where they have a higher mortgage interest or significant medical expenses, or they had a large charitable contribution. Okay. Coming down to our credits, some other ways that you can take advantage of in reducing your tax liability. And these are certain credits that are available, and you would have to see if you qualify for these taxes or these credits. Now, there's something that is called as non-refundable versus refundable credits. What that basically means is, if it's non-refundable, that means IRS looks at how much tax you are owing, and it will subtract that tax out. But say you are owing $100 in tax, but you are due a credit of $2,000, then you probably only will get $100. The remaining $1,900, you won't get it. That's what the non-refundable means. However, there are exceptions to these rules as well. So you can definitely see if any of those have advantages. The ones that are refundable basically means is that after bringing your loss or your tax due to zero, the refundable tax credits allow you to get more refund from the IRS. And there are only very limited few refundable tax credits. But let's go through these in brief so you understand what they are. Child tax credit. If you have a child and they are under age 17, then you get up to $2,000 for each qualifying child. These are non-refundable, but partially it could be refundable. So So they'll start as non-refundable. For some reason, you weren't able to use all of your non-refundable, and you maxed out. They will check your AGI again and see where you fit. And if it's possible, then they will allow you even the refundable portion, the remaining. So say for some reason that your tax due was $1,000. The non-refundable portion will reduce that $1,000, but the other $1,000 you could still utilize as part of refundable portion. So you could get that $1,000 back, but you have to be in a proper threshold with your income. So an evaluation has to go. And now the tax softwares are very, very good that they'll do it automatically for you. So child tax credits. Then this credit for child and dependent care expenses, these are different from child tax credit. What this is an expense that you paid so that for your child or for your dependent, so you could work. And this doesn't mean that when you wanted to work, you put the child in school and you can take that expense. That is not what this is. This is more so as a child care or more of somebody, a babysitter that you're paying so that you could do work or you're looking for work. So those expenses do qualify as a child or a dependent care credit. Education credit. There is a little topic on this, so I will not go deeper right now. Retirement savings contribution credit. This is what we were talking about with the IRA or the 401k. So if you have put money in your 401k and your income is at a lower threshold, you can get some savers credit, that's what they call it. So you would be eligible for this. But it has to be at a separate, it has to be at a level of an AGI which is low. So again, that threshold has to be determined based on how your numbers come out. Residential energy credit. Say in your house you had some energy saving windows you put in. You insulated the house so that you have reduced the heat loss. Certain expenditures like this, roof, that is now allowing you, to retain heat and stuff. Anything that is residential energy saving, you can take advantage of that. Again, there's a max out of how much you can take as a credit, but when you do these expenses, you want to consider them. And certain times what happens is, if you say say your project is going to run for a long time, you want to do it in such a way that half of the project happens in 1 year, the other half happens in the other year. You can take advantage of the credit for 2 years, right? Meaning they're going to do a roof and your insulation or the windows. Let's just say windows. And the company that you contracted with, they're going to do everything together. You can tell them you come and do it in November, December of last year, and then come and do the other in the other year. You can take the advantage of one in 1 year and the advantage of the other in the other year. Otherwise, what would happen is you have combined all your expense in 1 year, and because of the max out of the credit, you can't take the credit enough.
Is that applicable if you have a new roof put on your house? Or does it have to have the energy saving?
So the question is, does that have to have, if you put on a new roof, does this work, or does it have to have energy saving? It has to have energy saving, right. If it's just a new roof that you're putting and there's no energy saving, then that wouldn't work. So when you contract with you, or when you work with the contractor who's going to do the work, just ask them, can I take advantage of any credit from this expenditure? If you're putting in windows, you can ask them, are these energy saving windows? Because there are some, and you would be able to take credit for that.
But if you're part of a condominium and you're assessed, like $9,000 for a new roof, and unless it's energy, you can't claim it.
Correct, that is correct. So you can check with the condo board if the expenditure is considered energy saving, and you can.
Some paperwork.
Correct, yes. Yes, you would need to get that paperwork. Okay, so we're coming short to a time, and there's something called as EV credit. So if you are getting electric vehicle, it's pretty automatic. Your auto dealer will get you the credit, but there are some benefits there. Quickly, earned income tax credit. So these are the refundable tax credits. So earned income tax credit, as I was talking about, the additional child tax credit, which is the partially refundable portion. American Opportunity Credit and Premium Tax Credit. This is your health insurance through Marketplace. So you are getting credit. So say you paid more in your premium, you can get that as a credit. If you paid less, you may have to owe the IRS, and it all depends on what your income was at the end of the year. Okay. American Opportunity Tax Credit and Lifetime Learning Credit. So this is available for your child who is in college, and if for the first 4 years they're in college, they can take advantage of this American Opportunity Tax Credit, which means that any of their school expenses, whether they took out a loan or whatever it is, you get a form from their school, and you use that form to take this credit, and you get maximum of $2,500 per child, which could be a big chunk. And portion of this could be refunded. So save those expenses. If they are paying for books, if they're paying for supplies, that also get added to this credit. Lifetime Learning Credit is after 4 years, say they're going in grad school and they're paying for expenses still, now you get the opportunity to continue with taking the credit, and that is only $2,000 per return, but it's non-refundable. So you don't get, if you max out on the other credits, you don't get this credit. Okay. Estimated tax payments. All right, here's what we were talking about earlier, that say you are going to pay taxes, and this is your first year. IRS says it's okay. If it's your first year, you're not going to be penalized. But because it's your first year, from next year onwards, you should make sure that you make estimated tax payments. What that basically means is IRS likes their tax as you earn the income. They do not like that you earn the income, you hold on to their tax money, and you pay them later. They don't like it. So therefore, you have to make estimated quarterly tax payments. And how you can go about figuring that is, this year, whatever tax you paid, you can choose to pay 100% of that next year in 4 quarters. So you divide that tax by 4 and pay that as quarterly. So April 15, and then June, September, and January. And yes, so you pay this either via 1040 ES, which is a form that you can take, or you can pay directly online. And you want to avoid your underpayment penalties. Oh, one more thing that I was saying is, say you don't want to pay 100, you can figure out what your tax is going to be next year, and you think that you're not going to have that much income, you don't have to pay, but you better be sure that you're not going to have that much income, because if you are, then you will have to pay penalties and interest on underpayment. Yes.
I do that, but the question I got is, I do the best that's the calculation for estimation, and I'm low, so why do I have to pay a penalty for, my error, or not error, but, my judgment, whatever?
Right. So the question is, why would I be penalized for my judgment if I paid less? The IRS doesn't consider it that way. The IRS says you should have paid if you're a person who is earning on a regular basis, on that income you should have paid your taxes. Doesn't matter if your judgment was correct or incorrect.
Like investments, I don't know if the market's going up and down.
Oh, then you should make sure that you pay enough, because the IRS, huh?
I don't have a crystal ball.
Right. You should talk to some tax professionals that can tell you.
I am, but it's,
Because the way that the IRS says is, when you take the money out, you're not sure how the market's going to fluctuate. But when you take the money out, that's when you knew that you got this much. And that's when you knew that you have to owe tax on that. And you did not pay that tax at that time. And that's how they figure it out.
Does the same apply to state taxes where you pay 100% of what you paid prior year?
Same consideration for state.
everybody wants their money.
Yes, exactly. Okay, some common mistakes to avoid when you are filing your Form 1040s. Using the wrong filing status. Make sure you take advantage of the filing status that you have. Missing or incorrect Social Security number. Check your math. I don't think we need to, because the tax softwares are really awesome, so you don't have to worry about math. But if you're doing it on paper, yes, definitely check your math error. Forgetting to sign the return. This is very common. I have somebody who just I did the tax return for them, and they're like, I didn't get any refund. And then they get a letter from the IRS saying that you didn't sign your tax return. Okay, so omitting required schedules or forms. And you'll see it on the form, certain forms that need to get attached to your tax return. You should make sure that you attach them. Normally, everything gets e-filed. If you're not e-filing, this is when the situations arise. Failing to report all income. If you are earning interest, and you're earning interest more than $10, you want to report it. If you don't report it, IRS will do what is called as backup withholding. You don't want to do that backup withholding, because then you're under the radar of the IRS, and they will start taking tax out from your bank account. So, and they will always monitor your activity. So you don't want to do that. If you get interest, make sure you report it and you pay whatever tax applicable on it. Incorrect bank detail for your direct deposits. Make sure you check your account number, bank routing number, so you get your money right away. Claiming ineligible dependents. Entering incorrect tax withholding amounts. Overlooking tax credits and deductions. Failing to include IRA contributions. Claiming the wrong standard versus itemized deduction. Incorrectly calculating estimated tax payments. Not reporting cryptocurrency transaction. IRS wants to just know whether you have cryptos or not. They're not looking to tax you or anything. Only when you sell it is when you get taxed on it, but they're just looking to know how many people are investing in this virtual currency. Forgetting to include self-employment taxes, not checking for IRS updates before filing. Yes, so if there are any updates that are coming, you don't want to file it right away right now. Wait, I would say, till end of this month, because there are updates coming on the tax software as well. And failing to pay the amount owed by the deadline, filing with outdated or incorrect tax forms. You should definitely make sure that the forms that you're filing says 2024 and not the years previous. Overlooking medical and HSA deductions, missing penalties for early 401k withdrawals, not attaching necessary supporting documents, filing late without requesting an extension, submitting duplicate or amended returns incorrectly. If you are going to be late in your tax return, you have the option of extending it. The only thing that you don't have an option is on paying your taxes. So your taxes are due April 15, but your filing can be done later. Another thing that people worry about is, I'm getting refund. Do I still need to file by April 15? You don't. If you're getting a refund and you file late, no problem. But you don't want to file late because then it looks bad upon you with the IRS that you're a late filer, even though you're getting a refund. So if you know you're getting a refund, just file an extension and then file your tax return late. That's okay. And you get 6 months of extension after April 15 to file your extended tax return. So certain things to consider. IRS has a provision to free file your taxes. There's a income limitation. So if you go to the IRS website, irs.gov, they have certain companies that they are contracting with that offer free e-filing. And some offer actually even state filing also. They also came out this year in 2025 with another website where IRS is allowing you to file your taxes through their website, through IRS's website. But again, it's a pilot stage, so not everything is available. There are a few things that are available, very basic stuff. So you can check that out. And if you want to file your state taxes online for free, then you go to mytax.illinois.gov and register yourself, and you will be able to file your taxes there. And through these websites, you can figure out when your refund's also going to come. So if you, or even you Google it, where's my refund? And they will take you to the IRS website where you can find out where your refund is.
I don't know if the state has started this, but for the federal, every year I gotta get a new PIN number, electronic filings for identity theft.
Yes.
I also have a PIN from Illinois, which seems not to change, but I use that also for filing.
Yes, so for, say at 1 year that you had some identity theft and IRS has now put you as a person that has to receive a PIN number, or you have asked the IRS to give you
I never got hit with identity theft, but I'm just protecting myself.
Right, so that's why I'm saying is you have asked the IRS, so now you get this PIN number. So if that is the case, then you have to provide, if you're doing it yourself, then you just enter that PIN number. But if you have a professional who's going to do it for you, then you give that PIN number to them when they ask you. Don't give it right away. I think if you're married filing joint, you both get it. Both you and your spouse get a PIN number. On the state side, I didn't talk much, but certain things are it's just gonna flow from your federal return. Very basic, very standard things. But certain things that people do forget is if you have a house and you have a mortgage, you want to think about your real estate tax. You can take advantage of that real estate tax credit on your state tax return. So that can help you. And also, if you have a child who is in K through 12, then their school expenses, if it's above $250, then you can take benefits of that as a deduction or as a credit from the state. And I think that's it. So certain resources for you to take help from is you go to irs.gov for different forms, different instructions, and you can consult a CPA for any professional help. If you have some issues that are not resolved, you can consider this taxpayer advocate service. This is by IRS, and they would be willing to help you in resolving any tax situations, or for your friend. I think we have answered many questions, but if there are any questions, please feel free. Yes.
Say you did like a bathroom remodeling, and if you install a faucet that has that water limiting sensor or whatever, is that something you can report for taking advantage of that?
I don't believe so, because it has, so the question was, if you did a renovation in the house and if, and it's a water efficient faucet, will that be considered under itemized deduction? No, it wouldn't be. It wouldn't even be considered under your normal credit, because they don't have a category of such. Now, if you had this property as a rental property and you did this renovation work, then you can claim that as a deduction, but not on your property itself. You couldn't do that. Yes? Yes, go ahead.
What is it, I gotta look, 'cause I keep my taxes for many years. What is I can't remember, but if I screwed up, because I put new windows and insulation, I forgot to take a deduction, say 10 years ago. I can't like do an amendment.
If it's 10 years ago, you can't do so the question is,
I don't know, I mean, like, yeah, it's a long time.
yeah, so the question is, what is the statute of limitation in amending your tax return? The IRS allows you to amend the tax return for 3 years. So you go back 3 years. So if it's past 3 years, you probably won't be able to get anything back. You can still file the amendment, but IRS won't do anything after that.
You know, I can't remember, I think I did, but nightmares are coming back.
Yes. Yes.
Yeah, I just noticed on the table over there, you had an income tax return for seniors. And then why would you use that as opposed to the regular individual tax return?
Yes, so thank you for that question. So the question is, what's the difference between 1040 SR versus 1040 regular? So IRS makes it easier for you, if you're a senior who's over 65, to use the senior form where you don't have any of these other sort of complications. You just have income, or you may have Social Security income, simple things. That's why they're having a separate form. So you have the option to file either. One is just more simpler than the other, that's all. Yes?
Like, are you accepting clients if somebody wants to do a consult with you?
Sure, yes.
That's really.
Yes, so that is my email ID. If you have questions or if you want to consult with me, definitely I'd be happy to help.
I have.
Yes. Yes.
About the foreign income, which is unearned, you're getting rental
Yes.
income from a property in another country. Even though that rental income, you're not bringing it to the US, you are depositing it right there in that country, you still have to report it?
It depends. So IRS has, so the question is, if you have foreign earned income or foreign unearned income, do you have to report it on the IRS tax return, meaning in the US, do you have to report it? It depends on what is the amount of income in the US denomination. So there's a limit, and I want to say it's 10,000, but I'm not 100% sure. I would have to look at it.
Definitely less than, you mean $10,000?
Yes, $10,000.
Definitely less.
So if it is less, then you just pay it there and you don't have to report anything. But if you're paying significant amount of tax, you should report it here and then maybe take an advantage of the tax credit.
I mean, significant amount of tax over there.
Yes, over there, but in US denomination. So you have to change everything into US dollars. And if it's significant, then you should consider that. But if it's below that amount, then you don't have to worry about it. Yes.
Okay, I think we are done. It's already time, and
Okay.
thank you very much to